All right, welcome back, ladies and gentlemen, investors and traders alike. My name is Seth Golden. As always, I'm joined by Brad Carter, and this is Finom Group's weekly state of the market. So I hope everybody's been surviving the last 4 or 5 trading days where everything was going smoothly, markets were going higher, people were getting excited. And then, as the sign says, we may have lost our way. Now people are confused. Some are feeling lost, definitely unsure about what, the early 2023 rally was all about. Everybody's questioning it now. Was it just another bear market rally? Is it for real? Are we going back to test the lows? Let me ask you, Brad, what's the vibe been about on financial media? Is there a lot of we're going back to the lows, we're gonna retest the lows comments out there? Is there a lot of the analysts and strategists that go on CNBC? I haven't been able to watch a whole bunch of it.
Well, as I like to say, I try not to watch a whole lot of it. But yeah, that stuff's out there. There are competing views, of course, but as you've noted many times, CNBC in particular tends to bring out the negative side more than they do the positive guys.
It works for them, though,
and that's a little bit irritating to me. And the reason I tune it out quite a bit is that I get that I'm receiving heavily biased information, and that can mess with your own psyche and your own game plan and everything. And one thing I'd like to say that's real important, and I've been thinking about this all week. Seth, you and I both said from the get-go, we think this is going to be a pretty good year, but it's not going to be straight up. It's going to be choppy. There are going to be ugly moments. And so despite that, when these ugly moments happen, we don't like them.
Yeah. I mean, can you see these things coming? Absolutely. It's just part of a normal market environment. Pullbacks are normal to be expected. I mean, the average year has 5% pullbacks. The average year, going back to 1950. If we go back to 1980, the average year has a 13% correction. So these things are to be expected. But yeah, I guess my overarching point is people shouldn't feel like just because we're getting a pullback. I mean, you can't have the opinion we do nothing but go straight up like 2017, right? Not in this environment where the Fed is still raising rates. We still have elevated inflation. We are not, there's enough uncertainty out there, to when we get to certain mile markers, like we almost got to 4,200, there's going to be this natural proclivity for folks to start selling, taking profits and what have you, and trying to reload on pullbacks. So I think absolutely to be expected, this consolidation phase, in my opinion, normal. I mean, we ran pretty hot and heavy the first 6 weeks of the trading year, fired breath thrust, and now it's about how you engage this pullback. Are you confused? Are you unsure? Are you lost? Are you just getting your insights and information from the Bloombergs, the Yahoo Finances, the CNBCs of the world? And if that's the case, hopefully, the weekly state of the market can set you on the right path. So let's dive into, our, the meat of this week's state of the market here. As I always like to do, start off with, some thoughts, if not a quote, an investing quote. This one here: humans are addicted to doomsday narratives. I've noticed that sometimes people they actually want things to be worse than they are. So, the neuroticism and the paranoia will be vindicated, right? Most investors are a bit neurotic. They're a bit scared, skittish, if you will. And when they kind of seek out bad information, they seek out narratives that they think will ensure that their portfolio doesn't fall off a cliff, right? And if they find one, they're like, oh, so it was okay for me to be worried. In the meantime, the market starts going up. but they've digested this information and now they're sitting on their hands. So, I want investors to realize that, look, the financial media, it's a business model, and the number one objective is to sell ad space. How do you sell that ad space? By increasing your audience. The more people that tune into CNBC, the more ad revenue they can sell. Because if I'm Procter and Gamble, if I'm Pepsi, and I'm looking for a commercial spot, I want that commercial to be seen by as many people as possible. And how do you, capture an audience? It's usually with fearful narratives, as unfortunate as it may be. The wall of worry in the market is always there. The market climbs that wall of worry over time. All right. One of the quants that I wanted to start off with this week, and by quants, for those of you who are new to our state of the market, it means quantitative data. It's historic data. When this has happened in the past. So last year, and a lot of you might remember this quantitative data set here, we finished the first half of the year, so 2 quarters, that we lost 20% or more. So by the end of June, we were down 20%. Now, over a 2-quarter span, that has only since 1962 happened 1, 2, 3, 4, 5, 6, 7 times previously. As of June 2022, it was the 8th time. And so if we look forward, the next quarter, the market was only down 1 time, the next quarter, until 2022, where this actually went red. Because in Q3, recall that we were also lower at the end of September. We closed around 3,600 or so. So we were down 3 quarters in a row. But after that, so this would be 2 quarters later, the end of the year last year, the market had never had another down quarter. And we were positive. We were higher than 37.85 to end the year, because we were at 37.85 at the end of June, or the first half of the year. So this was green, and historically it's always been green. So this piece lived up to the hype. Now, a year later would take us out to June. The end of June this year would be a full year later, and a full year after a 20% plus 2-quarter drop, the market has never been negative. So in terms of, where could there be a floor for the market up to the end of June period? 37.85 historically could be the floor if this stays 100%. So just a reminder here, because we haven't talked about this particular data set in the past. We always talk about breadth, right? And we've had several breadth thrusts fire this year. And this is another reminder from Fundstrat. Now, we covered this in our weekly macro market research report in mid-January. We talked about the breadth thrust that had fired on January 12th. We had a BAM, or a breakaway momentum breadth thrust, by Walter Deemer. We had a Whaley breadth thrust by Wayne Whaley, the famous quant himself. But we also had what's called a 70, which was developed by Quantifiable Edges. You can find Quantifiable Edges Twitter account and their website as well. We had 3 breadth thrusts here, folks. We actually had 4, not listed here, but we've gone over it before. There was a breadth thrust called the Super MBI, Moving Balance Indicator. The super overbought MBI, developed by the Lighthold Group. Folks, we had 4 breadth thrusts that fired there in mid-January. 3 months later, after just these 3 breadth thrusts, the market has never been lower. So these happened on January 12th. So if we look out 3 months, that takes us to what? April 12th? So February, March, April 12th. Where was the market on, let's go check it out. Where was the market on January 12th? Let's see. Yep, that's the S&P 500, which is positive now. January 12th, the market was right there. 39.83, folks. 39.83. So keep that on your radar, because this says we've never been lower 3 months later. So that's April 12th. 6 months later, also 100% positivity. 12 months later, 100% positivity rate. I mean, these things have happened in the past. They're happening now. This gives us something to look forward to, I guess you could say. At the very least, keep these studies in mind. Now, over the weekend, and Finom Group members know this because we get the report from Morgan Stanley, Chief Equity Strategist Mike Wilson. We got the report, send it out to our members, and it was kind of a missive. It's something he doesn't usually do. Mike Wilson usually just sends out what he calls the weekly warm-up report every Monday morning. But this was a rare Sunday publication sent out to all Morgan Stanley clients. And when I read it, it was kind of like a Sunday missive, if you ask me, where he was just really reinforcing that this market is only higher because of liquidity, global M2. That's this bottom panel here. What is global M2? Money supply. The basket that he's using for global money supply is the US money supply, China money supply, the European money supply, and Japan's money supply. Those 4 regions he's putting into one basket. And as you can see here, it's curled up sharply. There's actually been an injection of $6 trillion into the global money supply basket. And for this, Mike Wilson says it's the only reason the stock market is higher. However, we're in very thin air. We can't stay here for long. The equity risk premium is getting worse by the day. And we believe that the market can go down 20 to 26%. That was his Sunday missive to Morgan Stanley clients. Here's the funny thing. When he says the only reason the market is up is because global money supply, the fat pitch is, I forget the gentleman's name, but he looked at the same chart, read the same Morgan Stanley article by Mike Wilson, but drew a different conclusion. As you can see, this is the money supply down here. This is the S&P 500 up here. There's lots of peaks and valleys in money supply, right? The circled areas, you can see money supply is going down, but look what's happening to the S&P 500. It's still going up. Money supply going down, market still going up. Money supply going down, market still goes higher. Money supply going down, market still, so on and so on and so on. Using Mike Wilson's very own chart against him. So again, when we see these headlines, because Bloomberg picked up the same report from Mike Wilson, and just pounding the table, the market is going down, the market's going down, it's going to get worse, we're going to retest the low, so on and so forth. But even by Mike Wilson's own rationale, using his own chart, there's no real correlation between the S&P 500 and the global money supply. The things they say. We've got to do better than that, right? And this was really fantastic from the fat pitch. When they took his same chart and used it against him, I thought that was awesome. And all we hear is that the other thing we hear, right, Brad? Valuations. Valuations. The stock market's too rich. The stock market's too rich. I think we hear this every day. CNBC litters, I think, week after week with strategists coming out saying, the market is, what do you, when you hear that, Brad, like what do you think when you hear about all this valuation concern? Does that impede your game plan? Do you incorporate it to any degree? Or, do you just say, it doesn't faze me, it's not practical?
Yeah, the latter. Though I'll admit, when I was new, I would listen to stuff like that, and it didn't take me long to catch on. I've got a funny story to relate to that. Well, it's not funny if you were one of this guy's clients, but there's a local guy here that handles a lot of people's retirement money, and stuff. And Anita discovered that he had pulled all of his clients, this is what he said anyway, all of his clients' money out of stocks. And this was around 2012 or so.
Oh, holy hell.
Right in the middle of that just huge run up, one of the best run ups we've had in history.
Double-digit year 2012, 2013, and 2014.
Yeah, valuations are too high. Valuations are too high. Yeah. And you hear it every year.
Yeah. Yeah, I mean, that's the thing. Every year. It doesn't matter. We were at 15 times earnings back in October of last year. Was anybody pounding?
And they were saying valuations are too high.
Yeah. No, we got to go to 14 times.
Yeah. That's why I don't like listening to the financial media stuff. It's just, it's nonsense.
So thank you. And the reason why I bring this up is, right, as of last Friday's close, the S&P 500 forward PE multiple is 18 times, perfectly 18 times according to FactSet data, which is also this chart here, right? That's where most people get their valuation, their earnings updates and what have you from FactSet. So what I did was, okay, we're at 18 times. Now, I'm not saying it's cheap, but it's not expensive either historically. And what I liken it to is, so I went back through the FactSet archives. I wanted to go to 2020, right? Because we bottomed in March. We bottomed going, from Q1 into Q2, we bottomed. And we started, a new bull market late March into April and, through the remainder of the year. So I went to Q3, and this is what I found. This is Q3 2020. This is September of 2020 here. There's earnings. There's the, the price of the S&P 500 is the light colored line. Here's earnings, the dark colored line there. And here is the PE. The valuation, the forward 12-month PE ratio for the S&P 500 is 21.7. Folks, it wasn't cheap then. In fact, it was more expensive then than it is today at 18 times. So people were saying the same thing back here when it was even more expensive. To my point, to Brad's point, they just say this all the time. And the reality is, if you're looking for a correlation coefficient, right, because that's how we can kind of tell, does valuation mean anything for a calendar year? The correlation coefficient between the S&P 500 12-month return and its forward PE multiple is actually negative on a 12-month basis. That data goes back to 1950, meaning there's no correlation whatsoever. Valuation cannot determine what the 12-month return is for the S&P 500. It's such a bad discipline, all this stuff that we hear out there. And again, today the forward S&P 500 multiple is 18 times. Back in Q3 of 2020, it was 21.7. Be wary of what the financial media punditry are promoting day in and day out, folks. Here's a chart of the average change in the S&P 500 PE multiple following bear market troughs. As we've said before, we tend to see multiple expansion coming out of a bear market, coming out of and through a recession. Multiples expand. And this is the average change 3 months after the bear market has bottomed. Usually get 2.2 multiple points expansion. Remember, the low was about 15.5, we'll call it. 15.5 was the low multiple back in October of last year where the bottom was set. It put 2.2 multiple points on there, and you're up to almost 18. 6 months later, you can add 3.6 multiple points. 9 months later, 5.6. So the multiple expands because earnings haven't caught up to the better economic climate yet, but investors know the bottom is in, the recession is over, we want to be buying stocks at these lower values. Initially, everybody else can pile in, and they always pile in, and that's why you get even more multiple expansion. So heads up there, and that's what's been happening, to the chagrin of many Wall Street analysts and strategists. They don't like the multiple expansion, but this is what happens every single time. The playbook just repeats over and over. And at the same time, we're hearing, well, earnings are getting worse. Earnings are getting worse, right? We are pretty much done with earnings season. We have maybe, just a few dribs and drabs. Some retailers are still reporting, and they'll be reporting next week. Macy's and Kohl's. By the way, full disclosure, we are short Macy's long term. We actually covered some of our short this week, but we still have outstanding positions that we are more than willing to hold longer term on that one. But what this chart right here shows, and we've been reinforcing this one the last several weeks, is that the percent of S&P 500 companies with positive 3-month, i.e. the next quarter, which would be Q1 of this year, percent of S&P 500 companies with positive 3-month percent changes in forward earnings has inflected sharply higher. So when the analysts and strategists out there are saying that earnings are getting worse for 2023, that's actually not true. Based on company guidance, the percentage of companies with positive 3-month percent change in forward earnings guidance has inflected sharply higher. It troughed here around, so only 46% of companies had been, positively reflecting forward earnings 3 months out. Now it's 60.5%. And just as an update, because this updates periodically through the earnings season, it's now at 60.6%. And folks, you can grab this from Ed Yardeni, YardeniResearch.com, Ed Yardeni. So it's now even higher than when I initially started my notes for our weekly state of the market, even if only by 0.1% there. Things are getting better. They're not getting worse, despite what the punditry has been saying. And, whether it's earnings, valuation, look at the leading economic index. Also look at the yield curve being the most inverted since 1980, 1981, right? We've heard that no matter what part of the yield curve you look at. This is the 10s minus the 2s, this table right here. This is every time the 10s minus the 2s minus the 10-year treasury has inverted since 1965. Folks, look at the time between the, inversion and the recession. I mean, this one took 49 months. What is that? 4 years. It's 4 years. Go ahead.
Yeah, I've thought about this a lot too. So is it even a meaningful correlation then?
Right. There's actually the things that we look for signals, right? We're just naturally inclined to look for signals in the market, signals in the economy that may preclude a recession or a bear market, right? We as if we can stop them. But it's just human nature, right? We don't want to lose capital. We don't want to suffer drawdowns. We don't want to lose time. We just want to see up and away. I mean, that's the goal. But we think that, we can draw correlations from these signals, if you will. When look at the medium time between these inversion dates to the actual recession is 20 months. And as I always say, the inversion doesn't cause a recession. The inversion doesn't cause a bear market. Anything can happen between, over that span of time. You're leaving a lot of room for variables to inflict some kind of damage on the economy. And invariably, something always does come along, right? I mean, the inversion in the yield curve in 1998 did not force the dot-com bubble burst. And we didn't have a recession for 35 months. And that was only because we had 9/11. Did the inverted yield curve cause 9/11 in September of 2001? Of course not. So, people look at these things from the past, and there's such a long duration between the signal and the actual recession, where any variable can actually cause a problem in the economy.
Yeah, so it's probably just another spurious correlation.
Yeah.
In other words, there's
word,
other things going on causing that correlation to happen. And so in isolation, it seems to be a pretty good predictor, but as you've shown, it's really not when they give themselves such a wide time range for the recession to occur.
Exactly.
Well, yeah, we're going to have a recession sooner or later, and we're going to have a second and a third and a fourth and a fifth and a sixth.
It's a normal part of the business cycle. It just is. And this chart here is from Renaissance Macro. and I love this because Neil Dutta is the chief economist at Renaissance Macro. And he wholly admitted that, when he first got into this business in the early 1990s, it was yield curve, yield curve, yield curve. Just follow the yield curve, and you'll be fine. But what he found was when he did the chart of the S&P 500, looking at the efficacy of the yield curve inversion signal, it became less and less reliable, post the 1990s. The downward, trend line here basically depicts the efficacy of the yield curve signal with the price action in the S&P 500. The lower the line goes, or the downward trending line, tells you it's had less of an effective signal on what's going to happen to, or what is happening to, the S&P 500. And the other thing that I want to point out when it comes to the yield curve inverting is that the yield curve inversion thesis, so far as it points to a recession or signals a recession in the coming future, I hesitate to say near term, is that it hasn't been tested in the quantitative easing era or in the post-great financial crisis era. The only yield curve inversion that we've had was in 2019. And I know, people will push back and say, well, we had a recession in 2020. Folks, I hardly believe that the yield curve was predicting a global pandemic crisis that resulted in a global economic recession. If we can all agree on that was not what it was signaling, then indeed, the yield curve thesis has never been tested in a post-GFC and a quantitative easing era that we have been in since basically 2008.
Yeah, that's a fair point, because I think it's fair to say that the Fed manages money totally differently than it did before.
Yeah,
we're living in a different financial set of circumstances.
Right. Absolutely.
The bank liquidity, for example.
Right. The reserves that banks have today are not comparable because there wasn't Dodd-Frank pre-Great Financial Crisis.
Right.
And you didn't have these audits by the Fed, like we do annually now since Dodd-Frank, to make sure bank liquidity, bank provisions are, substantial enough, to go through tough times. So they can still lend, in pre-GFC climate. And I think that's one of the issues today, why, even things slowed down there in the fourth quarter of last year, but lending keeps going higher. And we'll get to that chart in a little bit, because we've heard about, and I'm sure you've seen this floated around, Brad, that banks are tightening their lending standards or their credit standards. And while that's true, I mean, I don't deny that. What I would say is they're still lending at record levels. Lending is still prevalent, folks. So, and I think that speaks to both the bank's balance sheets as well as the household balance sheets. All right, our first technical chart of the day, folks, and I think I actually tweeted this out over the weekend. is this comparison of the semiconductors, because we've seen semiconductors just, take off, moonshot. And for those of you who invest in semiconductors, individual names, or maybe just the ETFs that are available, and there's several, whether they're leveraged or not, you probably saw NVIDIA's results overnight, beating on the bottom line, beating on the top line. Their guidance for margins and revenues was above Wall Street estimates. It's kind of like a first, since maybe 2020, actually, coming out of the pandemic, and everybody had lowered their bar so much. So it was a trifecta, I call it, right? They beat and they raised, so to speak. Really strong report. NVIDIA just skyrocketed, and the semiconductors, followed here today. But this chart is a relative performance ratio, and I like to do these because, look, if you want to outperform the market, well, what do you have to do with your investment portfolio? You have to be in the areas of the market that are outperforming. So when we look at, the semiconductor ETF, SMH, relative to the market, or the S&P 500 index ETF, SPY, we can see that, pretty much since the beginning of the year, semiconductors have been outperforming. The trend line is now going up against the S&P 500. And historically, when that has happened, and we have this performance ratio above the 200-day moving average, that's the line here, the 200-day moving average, and the rate of change at the same time has breached 10%, historically, you've already had the bottom in the S&P 500. This is the bottom. This is the S&P 500 in the bottom panel here. So you get above this 10% line on a rate of change. Here's the arrow, and the trend line is above the 200-day moving average. Market had bottomed, takes off. Again, above 10% rate of change, back above the 200-day moving average. You had a test here also, but got back above, stayed above, market took off. Again, above the 200-day moving average, market takes off. So on and so on, folks. Again, we're looking for past precedents, whether it's corrective phases like 2011 or bear markets like here in 2002, here in 2008, into 2009. 2016, we had a really nice correction, got below, then got above the 200-day moving average. Rate of change hits 10%. That takes off, market takes off. Of course, here, get back above 200, market takes off. And it just happened here this year. Got above 10% on rate of change, and we are back above the 200-day moving average. History tells us the bottom is in for the S&P 500 every single time since 2002. Could this time be different? As we always say, it could be. But we're looking to lean into those probabilities, and I think that the report yesterday afternoon from NVIDIA speaks very loudly to risk on, as well as new economy over old economy, right? New economy, we think of semiconductors. The old economy, we think of transports, Dow theory. So heads up there. Now, this is a recent study from the Lighthole Group. It's called the 52-52. And as Dave Ramsey of the Lighthole Group writes, he says, most of our technical work is longer term in nature, and we tend to run certain models across multiple market indexes for substantiation and reinforcement. A timely example is the 52-52 model. We calculate each week for the S&P 500, Dow, Russell, and NASDAQ composite. This model compares the 52-week rate of change in an index to the 52-week moving average of the rate of change of that index. And as we can see, they circled here. This is the 52-week versus the 52-week moving average at the bottom. And we've just gotten over this downward sloping trend line. In other words, it's positive. And when it's positive, the annualized returns are 12.3%. When it's not positive, meaning it's below this line, the annualized returns historically going all the way back to 1930 have only been 1%. So we're looking at better performance based on this just happening per the Lighthold Group. This is the second time this Twitter account has done this, Brad. This guy on Twitter, David Marlin, he posted this from Bank of America, or Barclays, from Barclays back, I want to say, October or November of last year. And he decided to repost it here this year, which kind of speaks to the individual, in my opinion. I didn't say anything bad, mind you. I'm just saying I think it speaks to the person. So what this post says is, in the past 7 recessions dating back to 1970, so we're going back to 1970, equities never bottomed before the Fed began cutting rates. Now, when I saw this again, I was like, are you kidding me? Didn't we already do this before? But sure enough, he decided to do this tweet again just a couple days ago on February 19th. And I was like, buddy, what are you doing? Because I debunked this before. Remember, it says, in the past 7 recessions, equities never bottomed before the Fed began cutting rates. So forget a pause. This is a matter of they have to cut rates based on what he's saying or his interpretation of the Barclays chart. Well, what I found, going back to all the rate cycles since 1970, is that 1974, the Fed's first rate cut came on November of 1974, but the bottom was actually 1 month earlier in October. So he's already wrong. The market had actually bottomed 1 month before the Fed started cutting rates. Here in 1982 was the first cut in July. The bottom for the market was after. It was 1 month later in August. 1 month later, the first example, 1 month before. But what we know is we have one before, one after. 1987, the Fed cut in November. The bottom was November. So we have 1 month before, 1 month after, and we have same time. 1990, the Fed cut in October. The bottom was, again, October, same time. In 2001, the Fed cut in January of 2001. And most of us know the bottom didn't happen until like March 2003. This was almost 2 years, right? And then in January of 2008, they cut. But the bottom wasn't until March of 2009. So pretty much a full year plus. And of course, in 2020, the pandemic, they cut in March all the way to 0, and the market bottomed in March the same time. So this is just completely false. The reality is there's no relationship. I mean, we can have a month before, a month after, the same time, and as much as 2 years later. There's no relationship. But this is the kind of stuff that's out there on Twitter that you got to be weary of, because a lot of these folks are not doing any real due diligence here. You know, they see something from an institution like Barclays or Bank of America or JP Morgan, and they just repost it as if it's, the gospel, so to speak. Here's another chart from the Fat Pitch. Once again, he says, rising rates are not the enemy of investors, although it can often create more volatility. Indeed, when the Fed is raising rates, we tend to have more volatility. I'll give you that. I look at volatility as your opportunity. But if you're wondering if the S&P, one second. If you're wondering if the S&P 500 can go up when the Fed fund rate is rising, well, this is the S&P 500 at the bottom. This is the Fed funds rate at the top. There's often, times where they're raising, times where they're cutting, but the market is still going up by and large most of the time. So yeah, we can easily, most of the time that the Fed is raising rates, it's not to fight inflation. We rarely have these inflation cycles. Most of the time, they're just raising to cool down the economy a little bit. They don't want it to get overheated to where they actually do have to fight inflation, which becomes a more cumbersome exercise for them. So nice chart there. I had mentioned earlier about the leading economic index, because that's the other thing, the yield curve's inverted. We're 10 months in a row where the leading economic index is falling, right? So that always spells a recession. It's just a matter of when. And everybody says it's inevitable, given these two factors combined at the very least. Inverted yield curve, LEIs are down 10 months in a row. We've got to have a recession. It must be inevitable. But lo and behold, look what just happened here, folks. We've inflected higher. This is the Conference Board. They're the ones that issue the leading economic index. They also do the Conference Board's Consumer Confidence Index and the ISM Manufacturing Index. And what you see here is that this is the leading index, diffusion 6-month span. And the 6-month span, we have now inflected higher to the 40 level. From below 20, we'll call this 10, we're now at 40 on the 6-month diffusion index here. And circled, if you notice the circles here, every time we've done this, look what has this is expansion cycles, folks. The shaded lines here are your recessions, the shaded lines. The shaded vertical lines are your recessions, recession, recession. And here, where you can faintly see it, the recession of 2020, of course. But every time we've gotten to 40, expansion cycle, 40, expansion cycle, 40, expansion cycle, 40, longest expansion cycle in history, 40, expansion cycle. We're still in, this is the only one, granted, that has not seen the recession, but we're already evoking economic conditions or economic metrics that are saying expansion going forward. So, one of the things that I had mentioned last year, Brad, and you're in the trading room often, you've heard me use the phrase characterizing the consumer's balance sheet, their household debt, serviceable debt versus disposable income levels are at levels we haven't seen since 1970. That plus, all right, so that plus the excess savings that they've accrued through the post-pandemic period are like an atom bomb to all of these former recessionary levels in metrics such as the leading economic index. Essentially, all of that excess on the balance sheet of consumers or households gives them a lot more time to spend while government spending has contracted, while the money supply has contracted, even while corporate, inventory building came to a halt because they overbuilt, in 2020 and 2021. Now we're living off the consumer. This economy is living off the consumer, which it usually does anyway. But usually when you have these kinds of issues in corporate America, they bleed into, the private sector, but the private sector has been able to withstand because of those balance sheets. And that's why I've said it's like an atom bomb to all of these different former recessionary conditions. What say you, sir?
Yes. Changing the subject just a little bit, though.
Sure.
You were talking about all these things that could be negative indicators or positive indicators and so forth, and mostly debunking the negative correlations and so forth. What was the first year of the Dow Jones?
Oh gosh,
do you remember?
You have to go back to 1900, I think.
Yeah, about. If you look at a, I haven't done this in a while, but I used to do it as an exercise. Pull out a chart of the entire Dow Jones history, and it looks like one long secular bull market.
Right. Yeah.
They like you say all the time, they mostly go up all the time. So the best thing for us to do is have a strategy, tune out the noise, and manage the complexities that
Right.
occur when you get a little bit of a and they always are. They're little spurts of bear market.
Right.
It-
Yeah. Ideally, when people are reading these bearish narratives and all of the things that can go wrong, they forget that human ingenuity usually conquers those potential pitfalls. It's rare that, think about the energy, right? We thought we were going to have this European natural gas crisis through their winter, and yet, we thought we were going to have $140, $150 a barrel oil, come the winter time, and folks, the price of crude is half of that still, because governments put policies into effect that aim to get ahead of these potential pitfalls. We're looking at all these bearish narratives, or a lot of investors look at all these bearish narratives, all of these false accounts of history, as instead of realizing that the market is up 75% of all years. And we just need to manage cash wisely, have a system in place for taking profits, for rotating capital, so that we can, continue to, lock in gains while also looking at new opportunities and ensuring we have enough capital when deep value comes, when a correction, when a bear market arrives, to look at it and be able to act upon that deep value instead of wasting time.
A good analogy.
With these fearful narratives.
A good analogy, Seth, I think, is climate change. And climate change is something that I scientifically believe in. But I've never believed in the doomsday scenario that some of them put out there. And they don't all, but some of them do. Because I said, we're going to come up with technological ways to cover our own mistakes. And we're already doing that.
Yeah. Yeah.
We're going to mitigate our way out of that as much as anything. It isn't going to be about turning your AC down, or, it's going to be mitigation strategies through innovation.
Right.
So that's
exactly, it's human ingenuity.
There's a
we solve problems.
Well, we don't think positive just to think positive. We think positive because
history tells us that's the way to. Yeah, and you don't get out of trouble by what do they call it? Sticking your head in the sand, right? We can't fix anything with our head in the sand. So that's perfect. And here's the, like I said before, look what's happening here with the leading index diffusion 6 months. And look what's happening here with the weekly leading index, or the ECRI. That's inflected higher. It bottomed in October, and it's been rallying ever since. These are economic conditions, folks. Inflation, we got a key inflation data point tomorrow, which is the PCE data, which is the core, inflation gauge by the Fed. It is expected to be flat year over year and actually tick higher on a month-to-month basis. And just to kind of reassure investors, while the CPI print was hotter than expected on the month-over-month, it still fell year over year. The PPI was hotter, much hotter on a month-over-month basis, but it also still fell year over year. We are still seeing disinflation, folks. So do keep that in mind. Expectations are not always met, but the overall trend is disinflation, or down, when it comes to CPI, PPI, and the PCE. This is, of course, the rent index, and we haven't even seen, as I've been saying, the rent and shelter components of the CPI have still not yet filtered into the monthly CPI releases. Hopefully it comes soon. Maybe it comes by the Q2 period, but when it does, it will be like a sledgehammer. And all of this, well, the Fed has more to do. Higher for longer is a concern, and they may have to hike more. All of that is going to shift just as quickly as what we've seen in the economic data shift from slowing to re-accelerating here in the new year. These narratives last as long as the data trends. That's the bottom line. They last as long, the concerns last as long as the data trends. I had mentioned earlier about, yep.
I have a question for you.
Sure.
Do things like CPI, employment reports, and so forth around the first of the year trouble you as being potentially inaccurate?
I wouldn't say it troubles me, but I can't deny
that you trust it less.
We've had an unseasonably warm winter across the nation. And that did play a role in some of the consumption data that we've seen in January and February. I mean, there's been 60-degree temperatures in the New England area. And typically we're seeing snowmobiles and streets shut down on on the national news and blizzard alerts in the New England area this time of year. And I know for a fact there's been 60-degree weather reported in New Jersey and in New York and we just don't see that. So when you have unseasonably warm temperature, you can go on those job interviews. You can go to the car lot and look for a new car, a used car. So I think we've pulled forward some of that demand, and that's why we saw such a ridiculously outsized gain on a month-over-month basis in retail sales, and used car sale prices rose in conjunction with vehicle sales that jumped more than double digits on a month-over-month basis. These things just don't happen without some kind of unnatural force. And I think it's hard to deny that, early this year, there's been an unseasonably warm weather that has benefited the consumer as well as the labor market. And so that is going to subside, and we're going to just get into, more normalized consumption, normalizing used car sales, new car sales, and prices, because we've seen the used car sales index tick higher for 2 consecutive months. I doubt that's going to factor into the next release of the CPI, keeping in mind, and this is very important, don't miss this point, folks, don't look away. As I say in youth ministry, look over here, look over here. You don't want to miss this because you got to get the kids' attention. The new calculation for the CPI lowers the weighting for the used car component. So even though we have seen a pretty notable bump in used car prices by way of the Manheim index, as well as JD Power and Associates tracking data, it works with a lag. A, B, they've lowered the weighting of used car prices in the CPI, so it's not as big of a factor. We'll see how it all comes in, nonetheless. I had talked about, loans are still. Here's the thing: I hate soft data. All of your manufacturing and services, PMIs, that's all soft data. It's questions, it's a survey. Well, the same thing with this here. Senior Loan Officer Opinion Survey, soft data, asks about, are you getting stronger or weaker demand? And you can see here, down, down, down. I mean, just fell off a cliff in the fourth quarter into Q1 of this year. So in Q1, when they, took the data, they're asking about, they asked in January, these loan officers about demand as of the Q4 period, right? And this looks bad. However, when you look at all commercial banks, deposits, loans and leases, right? That's loans and leases is the middle shaded line here. It's just going higher and higher. This is what they're saying. But this is what's actually happened. We're literally at record levels when it comes to commercial banks, loans, and leases. That's why I say this is the hard data. This is what's actually happening in the economy. This is what people feel like. It's kind of like consumer sentiment data last year that, was the lowest level since 1980s. Consumers had the worst sentiment as gas prices were going higher and higher through the middle of the year. But retail sales kept climbing almost all year long, even while consumer sentiment was for crap. Consumer sentiment, university, it's just soft data. It's just asking questions. Retail sales, that's the hard data. And that was positive all year long. Same thing here. Soft data looks like crap. Hard data says record level loans and leases. What they say and what's actually happening can be two different things. And people are kind of worried about, well, consumer has too much debt, credit is $1 trillion, blah, blah, blah. But look at the percent of balance, 90 days delinquent. And this is by the various loan types. Credit cards keep coming down. A little bit of hiccup there. Nothing to worry about. Student loan debt, we know. Mortgages, down, down, down. Delinquencies just keep falling for mortgages. Auto loans, which I was a little bit concerned about last year, but 90-day delinquency rates have come down, down, down. Revolving credit, down, 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 down. It's not the amount of debt. It's whether or not you can service it. And clearly, based on this data from the New York Fed themselves, the consumer, the household is doing just fine. They're borrowing and using their credit cards responsibly. Here, now this is awesome. This is from Bank of America. They said, our economists are calling for average monthly payrolls to slow to 175,000 in Q4 2022. This was their forecast that they had put out about mid-year. They thought payrolls would slow to 175,000 by the fourth quarter of last year. Folks, we didn't have but one print under 250,000 in the fourth quarter of last year. So they were way off. But to conclude, they think we're going to have negative payroll growth of 175,000 in the first quarter of the new year. Anybody remember what January non-farm payrolls grew by? It was like 500 plus thousand, right? These are the professionals, right? These are the top-notch economists and analysts at Bank of America, Merrill Lynch. Wrong in Q4, and it ain't looking good so far to start the year, folks. Let's not knock on wood and jinx it, but you get my point. Here's the other thing we had talked about. I wanted to reiterate, with this jobs growth is coming, labor force participation rate is climbing. And historically, when you've had that combination, it doesn't happen in recessions, right? When you have the labor force participation rate going this way, like it did here, you're in a recession, in a recession, in a recession, so on and so forth, folks. When it spikes up, you're in recessions. This is going down, and it's below the zero line. Unemployment rate, net of change in participation rate, is going down. That's a positive sign for the labor force. But Seth, the Fed wants a looser labor, a labor market. I'm like, they can want till they're blue in the face. Their monetary tools really don't address the supply imbalance in the labor market. They're not ignorant of that. They know that it's not working. No matter how many rate hikes they've thrown at us and how quickly they've thrown at us, the labor market hasn't budged. It hasn't gotten looser. There's something else in this particular economic expansion cycle that they know cannot be addressed with rate hikes at this stage. And that's all I got for this week. I think we finished within an hour, Brad. All right, folks.
Very good.
Enjoy the rest of the trading week. Good luck tomorrow. We've got that last inflation data point, the PCE. Trade safely, and please join us here next week on State of the Market.